Good afternoon, everybody. This gives me great pleasure to welcome you, as I said, to our Friday seminars. We do these every Friday for the last 2 months now. Actually, just for a month, sorry. We planned it for 2 months, but we'll have more to come. Now, our institute, the Atal Bihari Vajpayee Institute of Policy Research and International Studies at the MS University of Baroda, has been set up fairly recently, funded by the Gujarat government and hosted at our university, which gives us full support. Since our focus is both policy research and international studies, we do this alternatively. So 1 week, this week is economic governance, public policy, next will be international affairs. And we do this for some time. Our idea is to bring together, make it more policy oriented, one, because that's our remit basically. And the second is to bring two types of speakers. One is, of course, and the other is to bring up a lot of young people. Basically, why wait for them to become white-head before you give them a chance? Let them come up in front. And that we've been trying to do. I'll quickly show you what we've been doing just in a moment. Okay, as I said, my computer is misbehaving. So I will just read out what we've been done. So over the last 5 events that we've had, we began with on the 11th of June, we had 3 young discussing India in the post-pandemic world. We subsequently had Dr. Shamika Ravi speak to us in post-19 real economy. Then we had Dr. Medha Bisht speaking on Kautilya Arthashastra. Today we have Dr. Ashima Goyal speaking to us on the macroeconomic perspectives of the emerging countries in the post-COVID era. The exact title, of course, being COVID-19 recovery and macroeconomic risk from the emerging market perspective. We shall follow it up with a discussion next Friday on India-China border, the risks, the India-China border. We follow it up with a discussion on the public investment in Kashmir, sustainability and issues of efficiency. And then we'll be completing with, we'll be looking at Atmanirbhar Bharat. And in between, we have Harsh Pant speaking on, again, global partnerships in India. And then we have discussion on Atmanirbhar Bharat on 30th of this month, Dr. Ila Patnaik. We also have a book discussion on the 7th of July, which is a book written on the Indus, uninterrupted Indus, a history of that, with Ambassador Satish Chandra would be speaking to us with the author Uttam Sinha. Today's guest, Dr. Ashima Goyal, associated for long with the Indian Institute of Development Research at Mumbai, based solid credentials in the field of macroeconomics, open economics, emerging markets, and the like. In fact, we have a book on the 20th century macroeconomic history of India, and the editing of the journal on macroeconomics and the emerging markets, work on the open economy. And I first professionally came to see her in the Global Development Network meeting in December 2000 in Tokyo, where she was awarded a prize for her work. It's been 21 years, but if I remember the prize, predating work from home and COVID, where she talked about her work from home would actually disadvantage women because they'd be doing both the work outside and work from home. Normally people thought that work from home will liberate women. This is what I remember. I may be completely wrong. Dr. Goyal can always correct me on that. With that, I'll not take longer because you're not here to see me. I'll ask Dipankar, let's start with Dr. Goyal, and after she finishes, you can comment on it and we can conduct it. So let's not waste time. I've spoken long enough. Dr. Ashima Goyal, over to you.
Thank you for this invitation, and I'm delighted to be here with the new institute, and I think these kind of think tanks have a really important role to play, because one of the things I keep telling my students is that we understand conditions in our country, and India is quite a unique country. And there are many issues in international fora also where we need to bring out, and it's important for the rest of the world also because we are quite large and we will be even larger over time. So the particular lecture I'm going to give, earlier version of it was first presented in the Macroeconomic Framework Working Group. Framework Working Group of the G20. Sanjeev Sanyal had kindly invited me. And specifically, my brief was to give the emerging market perspective on emerging risks, macroeconomic risks. So in the post-COVID-19 world, we see a lot of risks for emerging markets. And I'm going to talk about these and what we can perhaps do about them, how they can be mitigated. So I'm just sharing the slides. Can you see the slides?
Yes, ma'am.
Just trying to set up slideshow. Okay.
If on the full page, we can see it better.
Yeah, I'm trying to do that slideshow. I've clicked slideshow, but it's not full page. Okay, I'll do it from below. There's this. Now it's fine, right?
Yeah. Perfect.
Okay, so I'll first start by talking about the uneven fiscal space across advanced and emerging markets. Then the specific macroeconomic risks, talk about India's experience, and then spillovers to emerging markets. And finally, I'll argue that there are various reasons why there are greater returns to some kinds of coordination in prudential and macroeconomic policy, not just for emerging, but also for advanced economies. So the fiscal space, it is all countries have equal needs, to fight something like the virus. But advanced economies have been able to spend much more in protection and stimulus. A rough figure in early part of this year, I put together these numbers in March. That time, I think, drawing on the World Economic Outlook and so on, advanced economies spent about 20% of their GDP in COVID stimulus. Imagine 20% of the GDP, which is a very high. In the US, it's even, I think, 30%. Emerging and developing economies, it is about 6%, and for low-income countries, 3%. And it's not surprising that, therefore, the recoveries we are seeing also asymmetric, with advanced economies recovering much faster. But the virus is changing shape and appearing in multiple waves. So it's not that easy to defeat. We can't say we are post-COVID-19. There are a lot of uncertainties, and further spending may be necessary. While vaccines are a hope, but then again, we are seeing vaccine hoarding, where 81% of the vaccine stock is with advanced economies, and they account for a very small percentage of the infections. And in populations which are not vaccinated, obviously new variants can evolve, and then they are a risk for advanced economies themselves. So if we look at the borrowing, this kind of stimulus spending is not possible even for advanced economies without a lot of borrowing. So the debt GDP projected rise for advanced economies is something like 20%. For others, it's much lower. But the surprising thing is that while their debt to GDP ratio has gone up from below 100 to much above 100, their average debt servicing ratio has really fallen. So what is the reason for this? What is the explanation for this? And it is that interest rates are very, very low. So although their growth rate tends to be much lower, the real interest rate minus growth rate is negative in many of these countries. And when we look at debt evolution formulae, they tell us that if R minus G is negative, then even if your primary deficit is positive, the debt ratio can fall over time. So in the literature, there's a lot of discussion of this so-called snowball effect. It's called the snowball effect. Now, emerging markets also have this because for them, growth rates are much higher. So R minus G is negative because growth is higher. But the problem is that their borrowing costs are much higher. Emerging market governments, there's much more volatility, uncertainty, a possible sharp rise in risk premiums. For India, for example, currently the government is borrowing at 6% and it's come down from a peak of 8% a couple of years back. And interest payments amount already for 3.6% to 3.6% of GDP. While for advanced economies, it's about 1%. So therefore, there are limits on how much you can borrow and spend, that unequal space. And it follows that policies for such economies must be about reducing this risk, which can raise interest rates further and increase borrowing costs and debt servicing costs. These sources of risk are both domestic and international. And how can you reduce domestic risks? By tax reforms, asset monetization, limited stimulus, and used most effectively, so that a lot of the stimulus supports growth and has long-term effects, so that the increase in debt or the total debt is sustainable in the medium term. International, we need policies that reduce spillovers. There's more prudential regulation. Rating agencies, they're very quick to degrade emerging markets, then their borrowing costs rise and the whole kind of vicious circle is triggered. So provide safety nets. In fact, one academic made the suggestion that since advanced economy governments can borrow much more easily, some of this borrowing should be made available to emerging and developing economies, but that won't happen. So they have to largely fend for themselves. So now, what are some specific risks as the recovery progresses? So this rise in government debt, which we've already seen. The advanced economies are able to borrow and fund this spending, and they think that as GDP recovers, they'll be able to reduce debt ratios. But the issue is that for a long time, the argument made was secular stagnation, that savings are much higher than interest rates, therefore interest rates than investment, so therefore interest rates will remain low. But now a lot of governments are saying that we did not do enough fiscal spending after the global financial crisis when rates were also low. We should do it now. So if there is a large kind of, like the US has announced a huge plan for spending on infrastructure, then we could see that savings might not, that you might see pressures on interest rates, that savings might not exceed investment might rise to equal or exceed savings. In fact, when the US stimulus was announced, there was a warning jump in benchmark US government 10-year bond yields. They were around 1% in January and rose to 1.6%, despite all the QE and accommodation from the Fed. And immediately there were some outflows from emerging markets and a rise in their borrowing costs internationally. But then the Fed has been doing its best to convince markets that despite this asymmetric recovery, we are seeing recovery in the US. There are inflationary pressures also because of cost push. It's been doing its best to convince markets that this inflation spike is expected to be temporary, although inflation has risen to as much as 5%. Their target is 2%. And over the past decade, inflation has been much below 2%. So again, interest rates have softened. But just as it's necessary for emerging markets to sort of look at medium-term sustainability of debt, it's equally necessary for advanced economies because there are risks from excess stimulus. In 2018, similarly, as they were raising rates, 10-year G-Secs had reached 3%. And in 81, they were as high as 15.4%. Now, if they were to shoot up to any of these values, advanced US debt would become unsustainable. And moreover, the huge amounts that they are spending and transferring that they have, there is an argument that when you protect industry too much, leads to zombification, that industry that should exit and go in more sustainable areas, resources that should be reallocated are not done. And this partly explains Japan's very low growth over so many decades, because their government borrowed and spent too much and they're not able to recover growth despite that. So it's much better to spend carefully in ways that enhance productivity. But now this large spending and the quantitative easing that the Fed is doing, as well as its withdrawal, both create risks for emerging markets. Throughout the 2010s, after the global financial crisis, we have been battling with these kind of risks. They lead to capital flow surges and sudden stops that coincide with changes in global risk. When risk is on, there's risk on, capital comes flooding in and it goes out whenever risk is off. And Europe and US are the center for stock markets and are the source of much of these flows. So now I'll come back to this, but Fed communication on exit will be critical to prevent another taper on. It was called the taper on crisis when Bernanke announced they would be withdrawing QE. This was in 2013 and we saw large outflows and tightening, which reduced our growth rates. You also require regulation of the non-bank financial sector in advanced economies. Too much, it's been focused just on banks. Emerging markets are told to follow exchange rate flexibility, etc. But this is not inadequate as a defense to excess flows. So those are major macro risks. Now, while this is not so relevant for India, but a lot of middle-income emerging markets face problems in debt rollovers. A lot of them have much external debt. In India's case, it is low. But again, it is ironic that there's a lot of discussion of emerging market and highly indebted poor countries, that is that HIPC, refinancing this debt and the problems this will create in markets. But it is ironic because 80% of the global rise in debt is due to borrowing by advanced economies. But nobody says that's going to be a problem financing. All the focus is just on the 20% which poorer economies have borrowed. The G20 did give them some time, some delay in servicing official loans till end 21. But this is not extended to private creditors. And in general, past debt crises tell us that restructuring must be generous. Otherwise, it doesn't work and they just repeat it. It's like kicking the can down the road. One major problem is going to be that there is these Paris Club creditors, which are the OECD countries and which largely lend, and IMF and other Bretton Woods institutions, and largely lend to the poorer countries, but their share in lending has gone down. The share of private markets has gone up since the since the 2010s. So this is going to make resolution problematic, since the sort of restructurings and agreement on restructurings, some bondholders can litigate. And my view that already these countries pay a large premium. So there should be bail-in of private creditors also, but they're themselves reluctant because they want to retain access to capital markets. And then, you have various solutions like Brady bonds and so on, but all this is largely you borrow, these countries borrow, international institutions help them borrow to repay their debts when they should be used for proofing the world from COVID-19. So I think there has to be some agreement on making resources available to these countries, and also for bailing in private creditors. They should face up to the risks they have taken. The other major issue which creates risks for emerging markets is that while they systematically moved the East Asian crisis in the 90s, a lot of them, the countries that were affected, suffered because they had high international short-term debt, which the rollover becomes due in the middle of a crisis and it aggravates matters. So they systematically reduced short-term debt, but increased equity. And this really helped them in the global financial crisis because equity is risk sharing. When it goes out, prices are crashing, they take out less. The resources they take out are much less. The liability of the country is less. But the problem is that in the period after the GFC, the reform in regulation, the AEs, because they were leading this, they focused more on banks, since banks were the source of the, the mortgages and the etc. that led to the crisis. But then always there is arbitrage in financial markets. So as a result, a lot of the cross-border flows are foreign portfolio flows to emerging markets. And in general, mutual funds' share of financial assets has risen sharply as bank cross-border flows have fallen. And shadow banks, as they're called, or non-banking financial entities have increased in most countries. So, and these are the ones that are responsible for these surges of capital flows that we have seen through the 2010s and that created risks for emerging markets. But there is no, in the US and UK, which are major source countries, there's no prudential regulation of the non-bank financial sector. So this is obviously an area where international institutions and there is requirement for coordinated, better prudential regulation. One major way in which these kind of absence of prudential regulations affects us is in oil prices, which are a major issue for India. So there was sort of liberalization, ideological liberalization in the world in the 90s. And as part of this, the US Commodity Futures Act reduced margins and position limits in commodity markets. And there are very large changes in oil price volatility followed this because commodities became an asset class and markets tend to overreact. And this interacted with large cross-border flows. And if you talk to people in oil markets, to producers and consumers, both of them suffer from this kind of volatility. Producers prefer a stable price of $60, which would enable them to invest and so on. While consumers, of course, would like low prices, but don't want very high prices, which happens when the supply side does not respond. But I'll just show a graph which demonstrates these fluctuations. The fluctuations have been less because of one factor, which is the shale oil, which is easy to set up. And so the new supply easily comes into the market. Now, if this graph, if you look at it, you'll see that after 2090s, oil Brent spot price was more or less flat. The volatility was very low, around $20, maybe reaching to 40 in the 90s, the Kuwait crisis, but around that. But after that, early 2000s, we've seen huge spikes, that big spike above 100 in 2007, 2008, which predated the global financial crisis. Then they plunged and they recovered. And now we are seeing, as I said, that the fluctuations are still there, but they are somewhat lower. Now, the current spike in oil prices that we are seeing was last year, the shale, with this fall and with the COVID, the US was affected, the shale industry absolutely collapsed. But now that prices have risen above 60 and 70, again, it becomes profitable. And as I said, it's easy to set this up. So we might see some softening of oil prices, but these kind of fluctuations are really affecting us adversely. So after flagging these general macro risks in emerging markets, we come to some specific Indian experience. What was India's COVID stimulus like? So here, monetary stimulus led the way with all kinds of regulatory relief, moratoria, restructuring. The government focused on medical facilities, food, unemployment insurance, which is sort of distress help, which was required. And through 2020, it was accused of underspending. All analysts were saying that this is, they would straight away they jumped to comparing with the US, and India is very, very different. So But when the fiscal deficit was revealed to be 9.5 against a target of 3.7, then the debate switched to worrying about debt and its financing, which is always a problem for emerging markets. India's debt to GDP ratio is now about 90%, center and states together. So the analysts were asking the government to clone the kind of protection transfers that advanced economies were seeing. But the other point to note is that the US is doing this sort of thing, giving everybody dollars in their accounts, but then it spent 30% of its GDP. Now it has about 300 million population. We have 1 billion plus. If we were to do this for our population, it would require 60% of GDP. No? So we have to remember that we have much more poor and we have a much larger population. So therefore, our reforms, our fiscal side has to concentrate on improving supply conditions, front-loading infrastructure spending. And this kind of high multiplier expenditure and relative conservatism makes monetary accommodation more feasible. As we said, government borrowing costs have come down, but they're still high compared to advanced economies. So Reserve Bank open market operations help to keep borrowing costs low. In general, COVID was a set or sequence of supply and demand shocks. So initially, supply had absolutely crashed with the lockdown, so not much point in stimulating demand. But policies must be geared to keep demand one step ahead of supply, to lead to a gradual and sustainable rise in spending and production and so on. Another innovative thing in the Indian response was to use the financial sector, because this is below the line. It does not impact current government borrowing and therefore reduces pressure on interest rates and markets currently. And moreover, I will argue that India was very well positioned to do this, because last year we saw another thing that a lot of analysts emphasize was the financial sector is in such a bad state, NPAs are high, banks are not lending, this will not work, banks will crash, etc., NPAs will rise steeply. So it's been a big surprise over the past year to see that banks seem to be continuing to do well. Partly it is the restructuring and relief given, but it is also that reform had been going on through the decades of the 2010s, and it had reached a critical mass where NPAs had really fallen. And there was a whole change in the ethos towards risk-based lending, which meant that if banks were lending to SMEs and so on under government warranties, which reduced the reluctance to lend. So, and then they would lend to firms that were long-term solvent. No? So this would be sustainable. So in that sense, NPAs would not rise that much. And to the extent there's recovery, and this is another surprise, that intrinsically India has good growth prospects for a number of reasons. So we saw very sharp recovery after the first wave. A lot of people were repaying loans. And similarly now, even after the second terrible, very costly in terms of human lives, but again, the recovery is more rapid than expected. And in general, to underline the previous discussion or to link to it, COVID-19 has facilitated, and India's example illustrates this, a new kind of crisis response. Earlier, emerging markets were always asked to tighten, to reduce spending, raise interest rates in a crisis to prevent, because there's said to be overheating, to prevent foreign capital going out, give them higher returns. But now the RBI is also using a variant of QE. It's expanding its balance sheet for the first time. Interest rates are staying low, and the fiscal deficit is being financed at lower cost than earlier. And so all this helps to keep real rates below growth rates, which helps debt ratios come down, that snowball effect. But of course, it needs to be under control. Like we had over-stimulus after the global financial crisis led to double deficits, and after that over-tightening. So now hopefully it will be more balanced. And we will be able to negotiate this period without a sharp rise in risk premium. So this is the argument I was saying, that India, while the 2010s credit was increasing worldwide under quantitative easing, but we had tight financial conditions. The rise in debt was much lower than in other emerging markets and in advanced economies. While emerging markets saw a large rise in corporate debt, in India there was deleveraging. Corporates, because of the IBC and other reforms, corporates were afraid to borrow. They wanted to shift to equity if possible. And because bank-based lending and the extra regulations imposed as part of global new norms on banks again hurt the credit dispersal in a country like India. So in a way, we were ready to use credit-based stimulus with less risk since our leverage was not high, unlike in most other countries. So this is a table which illustrates what I'm saying, because it's showing that India, compared to all economies, advanced economies, emerging markets, everywhere our credit ratios are much, much lower. And there was very little rise, and this is in Q3 2016 BIS numbers. The one figure where India is higher is in credit to government, which is higher than that in other emerging markets. We're often told that our government debt is very high compared to East Asia and so on. So there's some truth in that, but still, India's government debt was 68.2 in 2016. Now it's 90. And emerging market average was 47.5. But households and corporates, the borrowing was much lower. There's total crowding out of private credit. The other advantage India has in navigating global risks in this period is that we followed a gradual and sequenced capital account convertibility. And debt has been capped, fixed income or debt flows have been capped as a percentage of domestic market stock. Developing debt markets is very, very important for financing infrastructure and so on. But there should be sequenced, the share of flows should be in line with domestic markets. Share of foreign borrowing should be in line with domestic market development. After the global financial crisis, one reason emerging markets really suffered was that there was a push as part of this QE and search for yield. There was a push, a lot of foreign funds were willing to come in and give into local currency bonds, which don't have the foreign exchange risk. So there was a big push to open this, and some emerging markets did do this. But during the taper on and so on, it led to much more volatility in those countries. And now again, we are seeing QE and its withdrawal as the advanced economies recover. So those same risks. But the argument is that we saw that when Bernanke first announced QE, there was large volatility and outflows from emerging markets. But then Yellen came in and she actually raised rates without any of these tantrums, because much more data-based guidance. Because if you are raising rates as growth is recovering, the markets benefit from growth. So there's not so this sort of data-based gradual rise with good communication should work. We might be able to avoid those global risks. And then moreover, this next table illustrates, this was in 2014, the taper-on crisis, and a sort of almost developed emerging market, South Korea, Indonesia, and India. Now the share of bond markets as a percentage of GDP is very high, 75% in South Korea, India 54%, Indonesia 15%. But the share of foreign investors was very high in Indonesia because they opened out for the local currency borrowing bonds. They did a lot of that. And in South Korea, it was 10%. In India, because we have these caps for debt shares, it was only 4%. So with the 10-year, with the taper on in 2014, the 10-year yield rose 6% in Korea, 17% in Indonesia, very high interest rate volatility, which upsets the domestic cycle. And India, it was only 1.3. So these kind of self-defense, is also required where India has the advantage. Then coming to the issue of international spillovers, like here, please tell me if how much time I have. You want me to stop? I can stop anytime.
How much time do you want? Because for 5 minutes more, 6 minutes more, then people can ask you questions also. We don't want them to get you off.
Fine. So, the whole IMF, the Bretton Woods, there is an asymmetry in the assessment of spillovers. Like emerging markets where they, as I said, we're faced with these surges. So we do foreign exchange intervention, use capital controls, etc. But these are regarded as intervening in markets and creating negativities for other countries. But when advanced economies like FX intervention expands the central bank's balance sheet, similarly, advanced economy QE also does that. And since interest rates are at a zero bound, it acts largely through the exchange rate. But emerging markets are always lectured to use controls as a last resort, first try other sorts of exchange rate flexibility, etc. Reduce government spending, but all that will only increase investment in real estate where foreign investment comes and create too much volatility in exchange rates, which hurts trade. While advanced economies are not told, as I said, this kind of deregulation of commodity markets or counter-cyclical prudential regulations extending to non-bank financial sector also, where a lot of the arbitrage happened last 10 years because it was under-regulated compared to banks. So, for example, I was surprised to see, I was checking very recently, even today, UK and US don't have any prudential regulations on non-bank financial markets. So, and prudential policy, the research says that capital adequacy won't do for hedge funds. Simple leverage caps are easier to apply universally to shadow banks also. That prudential, these kind of measures are more effective in reducing leverage compared to buffers. That there's better incentives if the constraints are on creditors, on lenders. But the kind of regulations which we see are adopted more by emerging markets, they're more on borrowers, and leverage caps are underutilized, more emphasis on buffers and capital adequacy, which works only for banks. So the final argument I'm going to make is about policy coordination, because with these risk-on risk flows, the cross-border volatility, actually it hurts advanced economies also, because there is appreciation of the dollar. As soon as there's global risk off, everybody rushes back to the US. While a slowdown in emerging markets, the data that for 10 major emerging markets, IIP growth was 4.3% in the decade of the 2000s and 1.3% after the GFC decade. So these surges and the kind of adjustment we saw after the global financial crisis hurt emerging market growth. Global institutions are not able to protect emerging markets. And today, the share of emerging markets in global GDP in PPP terms has crossed 50. So therefore, the argument that if AEs recover, it boosts emerging market exports and benefits them, holds in the reverse also. If while there are some that are poor, there's a lot of heterogeneity and that need help. You were talking about debt rollover, but there are others that have good growth potential and as a source of demand for the rest of the world. So this graph shows how the share of GDP, the blue line is advanced economies, and we're seeing that the share of emerging markets has crossed that of, as a share of world GDP, emerging markets now account for a larger share. And this taper on crisis, you see a slight dip in that brown line, but then again, it started growing. So similarly, COVID and with this asymmetric spending and recovery, like the US is expected to grow at 6% this year, when normally their growth is 3%. So there will be a rise in advanced economy growth, but this status is not going to change because of the demographic advantages, catch-up advantages, which favor higher growth in emerging markets. So these kind of, the way the asymmetric power and the way the Bretton Woods institutions is set up has meant that emerging market issues are not given attention. There's a sort of one size, means whatever is best for advanced economies is best for emerging markets. You see this in the G20 communiques also, but Today, as I said, because of the various arguments I've tried to outline, coordination can improve outcomes even for advanced economies. With COVID-19, it's very easy to see unless the whole world gets protection, advanced economies are not going to be safe from the virus. And so there is a lot of things they can do to reduce risks facing emerging markets. A lot of things international institutions can do also. And the G20 is an example of a better balance in voice. And COVID-19 is an opportunity to switch. One reason for this asymmetries in power was that the advanced economies were exporters of capital and they were focused on protecting returns to capital. But in advanced economies themselves today, there's a realization of the negative consequences of increasing inequality and stagnant incomes. And it's an opportunity to switch towards using capital to improve lives and livelihoods, improve stability, and have more even growth, which will be more sustainable and have sustained benefits for all. So I think I'll stop there. Thank you.
Thank you, Ashima. Thank you very much. I'll hand you over now, proceeding to Dr. Dipankar Sengupta for carrying on. Dipankar, I see a question from DP Roy in the chat box, which I posted there. But it's all yours now. Over to you, Dipankar. Please unmute yourself and take on.
That was a great presentation by Professor Goyal. Too many ideas coming into my head. I'll basically have some points. I don't know, we'll take some of them. I'm using my situation here, exploiting my situation here to my advantage to ask the first few questions. You talked about emerging markets having less fiscal space than developed markets. As a statement, I think it is true. But as you said, I think in a case like India, I think space was available, fiscal space was available. We could have reached the 9.5 deficit, gone to 10.5 also. We wisely chose not to do so because I agree with what government spokesman that said that at a time when the slowdown, so to speak, that the fall in GDP is due to a lockdown, it does not make sense for you to increase government expenditure because that stimulus doesn't work when the economy is under a lockdown. So I believe fiscal space was available to countries like India. When it comes to emerging markets, it would depend on how big that particular market is and the openness of the market. If we are a big market and not all that open to the rest of the world, then fiscal stimulus, keep in mind what Mihir Rakshit used to say, it is the composition of government expenditure that matters. And so if you fiddle around with the nature of government expenditure, you can ensure that very little imports come in and lot of domestic output is actually increased. That's one point. Second point is basically this talk about inflation, I think is premature. Especially the point you talked about, the long-term government bonds in the United States in 1981. In 1981, Paul Volcker was fighting inflation, which had entered the expectations of the United States agent, and it had basically become a very dangerous circular loop. And that time he took interest rates sky high to break that, and he was successful. I do not think that we are in that particular kind of position now. Frankly, I think we shouldn't be talking about inflation at this point in time. We are not, I think, anywhere close to 1979 yet. The third is, I basically note with amusement, from 2014 onwards, the government was on a fiscal glide. It was reducing its deficit, and the Reserve Bank of India would not accommodate by lowering interest rates. If you look at real interest rates, they were rising all the way till 2018. And now with your fiscal deficit at 9.5, the RBI is practically accommodating everything. My thing is the following. At this point in time, let us not relate a conservative fiscal policy with RBI's policies. Because when we were really conservative, the RBI wasn't accommodating us at all. And now, of course, when all hell has broken loose, the RBI, in a sense, is going overboard in accommodating, and I agree with that particular kind of policy. The thing is the following. I think somewhere down the line, we'll have to look at the composition of government expenditure. I mean, I think the composition of government expenditure, particularly front-loading investment expenditure, highway infrastructural expenditure, in a sense, has been the wise thing to do. You are creating demand in those sectors where the capacities exist. And to that extent, I think we have been going on a wise path. My thing is the following. Yes, we should be mindful of fiscal concerns, but I think those concerns should not inhibit us from doing whatever needs to be done. That is not to say that we should increase our fiscal deficit. We have to ask ourselves the question whether increasing the fiscal deficit is good or bad. If it is good, increase it. If it is not, don't do it. But let us not get hemmed, let us not block ourselves in by talking about the fiscal deficit right now. That's my thing.
I think that's a lot of questions. I think, Dipankar, that's a lot of questions.
Yeah.
We'll have it from Ashima.
I think there are quite some questions in the chat box for Professor Goyal.
No, so let her answer this one first.
Okay, sure.
Sure. I agree with you that that India has space to spend what is needed, but not as much as what is asked. The ask is too much in a country like India, where you have number of groups and, like I said, 1 billion plus expenditure. In fact, I have a 1 million plus people. Potential transfer expenditure could hit the roof, protection expenditure. So I have a paper where I show that, talking about debt adjustment after COVID, where I show that counter-cyclical primary deficit. So that means spending more now when you need to spend more actually leads to faster reduction in debt. That means you reduce the primary deficit later, you increase it now. And I argue that there are signs after the FRB, and slowly we are seeing that each 5 years, the off-budget items have reduced. There's more transparency. This is because we had very high, the gap between the growth rates are much higher than real interest rates. We used to have high inflation also earlier. But debt did not fall as much as it should have because of these that composition and, the whole accounting of government budget deficits also, government budgets also improving. So therefore, we have space. I agree with that. I also agree about the composition, spending on infra, much higher multiplier. And also it crowds in a lot of private sector activity. Later on, it will really help sustain growth, which will bring down debt ratios. I agree with you that inflation talk is premature. In fact, the RBI also has been trying to communicate that the spike in inflation, it's risen above the tolerance band of the MPC, the latest numbers. And so you're hearing a lot of market analysts saying, we need to focus on inflation now. This is a pandemic, once in 100 years, and the amount of suffering. You have to support recovery, employment. When now, as I said, the market, they start shouting. So, this issue of India being a large, that you need to focus on inflation, think about tightening, etc., or normalizing at least. So this argument about India being a large country and therefore having space. See, the point is we are large, but we are open now. So you saw this in the global financial crisis. We used to joke that Chidambaram was the luckiest finance minister because anyway he was spending all those farm waivers and so on. And then the crisis came, and you could say part of global stimulus, we are increasing our fiscal deficits. But even he began to worry about consolidation in 2011 when we had the double deficits and international rating agencies were threatening to derate. And then what happens is that if we are at the lowest grade, if we are derated, our firms will not be able to borrow abroad, or they'll have to borrow at very high rates. So that affects, this is what I mean by risk premiums. And these rating agencies are unfair. Basically, their rating is based on growth, and your per capita incomes, not your policy so much. Like such high debt it's an advanced economy, nobody's derating the US and so on. But they will do it for an emerging market. So it's more difficult for us to access markets. So we need to access them. We need to raise investment above savings, but then we have to be careful about some of these issues about, as I said, our debt levels are higher than East Asian governments who tend to be very, very fiscally conservative. We're always being compared with them. So, I think there is space. I agree with you. There is space to spend, but and then this thing about the RBI accommodating today when they didn't accommodate in 2018, I think it has to do with partly a different philosophy of the top management, but also to do with the pandemic. Like I was joking in a recent interview, I mean, that this MPC, people keep saying there's so much consensus, no, contrary view, etc. But the reason is that this MPC set up during the pandemic. And when you have this kind of situation, everybody sees the necessity to support government spending, to support recovery, to help those who have really been badly affected. Yeah? Okay. I think I've answered most of your questions. Now I'll look at the chat. You want me to look at the chat or you want to take up?
There's a question from DP Roy, basically.
What do you see as the interest rate regime? Advanced economy is expected to raise rates. Do you think that we have reached the trough? Actually, as an MPC member, you're always asked to forecast what will happen to interest rates, and I can't talk about that. I don't want to talk about that. And I also want to say that these are my personal views, not those of the MPC. But, this thing about raising in a couple of emerging markets have raised rates, but advanced economies, all that the US Fed has done have brought forward the date of rise from 23 to 22 at present. So they are still at zero. They still have high quantitative easing. And they are very clear that we want to make sure that recovery is robust and sustained. But there are these lessons from the past Great Depression. The tightening came too early and then, it tipped into a further recession. So you have to be very careful. As I said, you should not be over tight nor overreact. Balance. So do not tighten too early, but do not leave it too late either, because otherwise, and then also we are in an inflation targeting regime. That signaling does go out. So again, I agree with Dr. Dipankar Sen Gupta that it's not the same thing as the Volcker regime where inflation was allowed to go out of hand. Today, there is that communication on inflation. In the inflation targeting period, average inflation in India has been 4%. So I do not think currently we are seeing oil prices rise and other cost supply chain problems, Indian as well as global, raising prices. But it is related to the special circumstances today. And I do not think that even though we don't have a very long history of inflation targeting, which serves to anchor inflation expectations, but we can ride on the good reputation of inflation targeting and the fact that you have to respond to inflation. So right. I don't think inflation is such a worry at present.
I see a question, Dipankar. Ashish Kotadia wants to ask a question.
Yes, sir. May I ask?
Please.
Yes, please go ahead.
Yeah, ma'am. This is Ashish Kotadia from the Department of Political Science. Ma'am, as you have mentioned about the 73's oil crisis, 90s decade East Asian economic crisis, and recently over a decade ago happened the global financial crisis. But ma'am, right now, India is having some, providential challenges like twin balance sheet problem, the rising NPA, a bad loan, a lower fiscal profligacy on the social consumption, and the higher right to debt GDP ratio. So according to you, how we could address this challenge while keeping in mind the macroeconomic recovery, while on the another side, we are having the problem that how we could address the rural credit delivery system. So how we could solve this entire problem?
India has a lot of problems, but it has a lot of advantages and potential also. There are people who see that given the demography and that India has, in 2030, we'll be much given the reforms that have been undertaken. So I think like for example, you were saying twin deficit, but we don't have a twin deficit today. We had a twin deficit in 2011. What is a twin deficit? It is a fiscal deficit as well as a balance of payment deficit. We don't have a balance of payment deficit today, right? So it's too easy to say we have problems and these problems continue, but we don't perceive the changes and the improvements. Similarly, you were saying high NPAs. Now, the RBI's last fiscal financial stability report predicted that NPAs would rise to 13.5% in public banks. But actually, their profitability has improved, and everybody was focusing on gross NPAs. The other feature was reforms. Their provisioning had improved so much that their net NPAs were only 3%, 2 or 3%. And gross NPA is still 8 because IBC, there's delayed recovery. And their, board governance had improved, boards had improved, their lending practices, risk-based, as I said. That is why the whole credit culture has changed. Now, banks are not giving those huge loans to corporates. That was the infrastructure boom that banks were forced to finance. That is not happening anymore. They are doing risk-based lending to retail, much as private banks are doing, while the government is warranting the loans to small enterprises. So even private sector banks are making these type of loans today. So this is the move towards explicit subsidization, not asking commercial organizations to do the government must do the subs, and that is a much healthier way of doing it. It leads to much less economic distortions. So, and debt, the GDP, we've seen the debt GDP ratio really come down in India. The rest of the world now, they're talking about the snowball effect that R is less than G and therefore the government should borrow. We always have R less than G, but just the pressure on spending too much. So, if you rationalize that, you don't spend too much. If there's a persistent rise in spending, it must be financed by a rise in tax, not by a deficit. Counter-cyclical deficit, a rise in debt today is not dangerous as long as it is, it's required. Our policy has been too structural and we've neglected counter-cyclical macroeconomics. And we need to do that. Okay, and rural also, we're seeing a lot of improvement. The rural economy is rescuing the rest of India over the last year. We're seeing large exports. That shows, this focusing on infrastructure. Like much better rural roads, I think are one reason that explain the sharp rise in exports of rural commodities we're seeing in India. So farmers, there is a lot of diversification in high value items. People are focused on the Punjab farmers who are fighting to preserve an old system, which is no longer the best for them either. Where the government, they're growing something which there is no comparative advantage, overusing water, all sorts of problems, but they're getting assured payment from the government. And actually, what all economists have been saying, improve rural infrastructure, allow them to export, to gain from international prices, give insurance to smooth volatility. Yeah. So there are many states and farmers that are benefiting from this. So India has problems, but it has made progress in solving those problems. Okay.
Yeah. I don't see more hands up. Before I move on to the last part of the program, many of you are raising the question about certificate. I'm putting it again and again in the chat box. Info. Yes, Nabunita, I've answered you also. info.aiprismsu@gmail.com. Please see our poster. Our poster has it also. So read our posters, send us, we've taken a screenshot of who's present. Accordingly, we'll give the certificates of participation to those who are desirous of them. So do we have any more questions? I don't see any questions or hands up. We've had a very good discussion. Ashima, before I hand you over, in Tinmurti, when you came and spoke and we published your paper, for the first economics paper in Tinmurti for years and years. So I hope I to get a chance to repeat in Baroda also. So I'll leave you with that thought. Okay? So Dr. Dholakia, can I request you to, our Joint Director and the Head of Department of Political Science at University of Baroda, Dr. Amit Dholakia, he will now do the honors, the pleasures of the stimulating discussion. Amit, right?
Thank you, Sakti sir. It's indeed my privilege to propose the vote of thanks for the wonderful talk given by Professor Ashima Goyal. It's wonderful because macroeconomics is a very, very technical and a difficult subject. But she presented the post-COVID macroeconomic challenges in such lucid way that most of us could really make out the nature of challenges as well as the likely way ahead for the economy to make the recovery from this unprecedented crisis that it was plunged into. Maybe I think the crisis was as big as the crisis that was faced during World War II. We are indeed very thankful to you, Professor Goyal, for sparing your valuable time and most importantly, sharing your very valuable ideas with this audience. I'm sure these ideas will be developed further by our students when they think about this pandemic and the post-pandemic crisis. And hopefully the video of this program that will stay on our YouTube channel will also be watched by a large number of people who are connected with policy making as well as with academics. So once again, on behalf of Sri Shakti Sinha, as well as on behalf of the Institute of Policy Research and International Studies, I extend my very heartfelt thanks to you. And thanks are also due to Professor Dipankar Sengupta, as well as all the participants in this Friday Talk series. Once again, we look forward to seeing you next week in another talk. And we actually have a book discussion coming up next week. We will share the details with you very soon. But do join us for this book discussion on a book that has been published very recently on the Indus Valley and its historical evolution and significance. Over to you, Sri Shakti Sinha ji.
Then nothing. You have said the vote of thanks. Ashima, just to say that two people of Hindu College, Ravi Day, who used your notes apparently, is junior to you, and DP Roy have said thank you, and DP was present at Talkative Murthy. So just to convey the feedback from them that I am reading in the chat.
Really nice to connect with so many people.
Thank you.
Thank you very much, Ashima, Shakti. Pleasure to always see you, Shakti, and talk to you. Thank you very much.